You downloaded the app. You funded the account. You followed the interface, trusted the recommendations, and did exactly what the platform was designed to make you do. And somewhere in that process, without a disclosure, without a conversation, without a single moment where anyone looked you in the eye and explained what was actually happening, the app started making money off you in ways you never agreed to and never fully understood. Not illegally, not technically. Every mechanism is buried somewhere in a terms of service document that runs longer than most novels and is written in language that requires a securities law degree to parse. This is not a story about one bad app. It is not a warning about obvious scams or fly-by-night platforms. This is about the mainstream investing apps, the ones with millions of users, billions in valuation, and full-page ads in the places you trust. The ones that built their entire business model around a question you never thought to ask. Not how do I make money, but how does this app make money off me? If you like content like these, hit the subscribe button so you don't miss our next video. This is not happening to a handful of unsophisticated investors. As of 2025, retail investing apps collectively manage over $100 billion in user assets across tens of millions of accounts. The average user is not a day trader or a finance professional. They are a regular person, mid-20s to mid-40s, moderate income, genuinely try to build something real, who downloaded an app because the barrier to entry felt low and the interface felt trustworthy. That trust is the product. Because the moment a platform achieves scale, millions of users, billions in assets, a brand that feels legitimate, the business model underneath it stops being about your returns and starts being about monetizing your behavior, your order flow, your attention, your tendency to trade emotionally during volatile markets, your willingness to upgrade to a premium tier that charges monthly fees for features that rarely improve outcomes. The people who built these platforms are not unsophisticated. They are extraordinarily sophisticated about extracting value from users who believe the platform is working for them when the platform is almost entirely working for itself. Here's exactly how the most popular investing apps actually make money. Mechanism 1. Payment for order flow. When you place a trade on a commission-free platform, your order does not go directly to the market. It gets sold to a market maker, a high-frequency trading firm that executes your trade while capturing a tiny spread on every single transaction. Legal, disclose in footnotes, worth billions annually to the platforms collecting it. The cost to you is invisible on any single trade and devastating across thousands. Mechanism 2. Premium subscription tiers. The free version works just well enough to keep you engaged. The paid tier, $5, $10, $15 a month, promises priority execution, advanced analytics, or margin access. Most users who upgrade see no measurable improvement in returns. The platform sees guaranteed recurring revenue regardless of how your portfolio performs. Mechanism 3. Cash sweep programs. The uninvested cash sitting idle in your account does not sit idle for platform. It gets swept into partner banking programs earning 4% or above, while your account displays 0.1% or less. The spread between what your cash earns and what the platform earns on it flows entirely in one direction. None of this is accidental. Every mechanism was engineered deliberately and disclosed just barely enough to remain legal. Here is what these mechanisms actually cost. In real, computable numbers. Payment for order flow. Studies analyzing execution quality on commission-free platforms consistently show retail investors receive prices fractionally worse than the best available market rate. On a $10,000 trade, that difference might be $3 to $8. Insignificant ones. Across hundreds of trades over a decade, thousands of dollars in quietly inferior execution that never appears on any statement as a fee. Cash sweep programs. The average retail investor holds between $2,000 and $5,000 in uninvested cash inside their brokerage at any given time. At a 4% yield the platform captures versus 0.1% credited to your account, that gap costs you $150 to $195 annually, per year, silently, on money you already own. Premium subscriptions. $10 monthly across 3 years equals $360 spent on features that peer-reviewed research consistently shows produce no statistically significant improvement in retail investor returns. Combined across a typical active user over 10 years, conservative estimates place the total extraction between $4,000 and $9,000, not in dramatic losses, in silent, systematic, individually invisible costs that compound against you while the platform's revenue compounds for itself. You are not naive for trusting these platforms. You are not careless for downloading an app that every financial publication praised, every podcast sponsor endorsed, and every friend in your network recommended. You are not unsophisticated for assuming that a platform advertising itself as being on your side was actually on your side. The entire design of these products is built to generate and sustain exactly that trust. The clean interface, the encouraging notifications, the confetti animation when you make your first trade, the language, democratizing investing, making markets accessible, putting Wall Street in your pocket, is not accidental. It is engineered, tested, optimized to feel like empowerment, while the actual business model runs quietly underneath it. You are handed a product specifically designed to feel transparent while being structurally opaque. That is not a personal failure. That is an information asymmetry maintained deliberately by platforms with legal teams, behavioral economists, and UX researchers whose entire job is ensuring you never ask the question this video is answering. The system worked exactly as designed. You just were not supposed to know how. Here is what changes the moment you understand how the platform makes money. You stop being a passive user and become an informed participant. That shift, purely cognitive, costing nothing, immediately changes every decision you make inside these platforms. You check the cash sweep rate before leaving uninvested cash idle. You compare execution quality across platforms before routing significant trades. You evaluate whether the premium subscription produces measurable, documented improvement in your specific returns, or simply produces measurable, documented improvement in the platform's monthly revenue. You start asking one question before every interaction with any investing app. Who benefits from this feature? This notification? This recommendation? If the answer is unclear, that lack of clarity is itself the answer. The flip does not require abandoning these platforms entirely. Some commission-free brokerages operate with genuinely competitive cash sweep rates and transparent order routing practices. The difference between a platform that extracts value and one that delivers, it is now something you can research, compare, and verify. Knowledge converts you from a revenue source into a demanding customer. And demanding customers cost platforms money, which is precisely why none of them are volunteering this conversation. Here are the exact steps to audit every investing app you currently use. In order. Step 1. Check the cash sweep rate. Log into your brokerage account right now and find the interest rate on your uninvested cash balance. If it is below 4%, your platform is capturing the spread. Move uninvested cash manually into a money market fund within the same account, or transfer to a platform with a competitive sweep rate. This one action recovers hundreds of dollars annually. Step 2. Search your platform's name plus payment for order flow and execution quality report. Every SEC-regulated broker publishes quarterly execution quality data. Compare your platform's price improvement statistics against competitors. If your platform consistently underperforms, that gap is a calculable annual cost. Step 3. Cancel the premium subscription for 90 days. Track every metric it claimed to improve. If your returns, execution speed, and decision quality are statistically identical without it, they almost certainly will be. That is $120 to $180 returned to your portfolio annually. Step 4. Before downloading any new investing app, search how does this platform make money before you fund a single dollar. The answer should be immediate, specific, and make sense. If it is not, walk away. The most dangerous investing app is not the obvious scam. It is a polished, well-funded, heavily endorsed platform that makes you feel informed while systematically extracting value from every interaction you have with it. The danger is not drama. It is comfort. It is a clean interface that never prompts a single uncomfortable question about whose interests it was actually designed to serve. You do not need to distrust every platform. You need to understand every platform, specifically, precisely, before a single dollar moves through it. Because here is a reframe that changes everything. These apps did not democratize investing. They democratized access while quietly centralizing profits. The barrier to entry came down. The information asymmetry stayed exactly where it was. You have now closed that gap. Every platform you evaluate from this point forward gets audited before it gets funded. Every feature gets questioned. Every default setting gets examined. You are no longer an unaware participant generating revenue for a system that never disclosed what was doing. That single shift from trust to informed scrutiny is worth more than any premium subscription any platform will ever sell you. If this conversation changed how you see these platforms, subscribe, because dismantling the systems working against your wealth is exactly what we do here every single week.